we want to talk to a man named Dino Kos. Dino has been at a number of places, including, well, Hamiltonian Associates, where he is right now, Morgan Stanley. And Dino, you also ran the operating activities of the New York Fed, I believe, for some 20 years. Let me start off right there. Are you happy with how the Fed is conducting itself right now?
Well, right now they are, but they're doing fine. But the important issues really are in Europe right now, at least in the monetary realm. So it's the ECB that we're looking at to respond to some of these problems that are happening in Europe. With the Fed, it's the regulatory side that's really in play right now. The Fed, the FDIC, the OCC, there's a lot of regulatory activity that's in play. The banks are really under pressure right now, which is what your colleague was just referring to. And the question is, what's the balance between the regulation that was called for after the crisis, on the one hand, versus the need to get the banks lending again and get the economy going. So that's the balance that they're trying to strike. I think the Fed's doing an okay job there. I think on the monetary side, again, I don't know that there's that much more that they can do. We can talk about that later. It's really the ECB where the onus is on to do something more.
No, talk about it right now. What can the ECB do that the Fed cannot do right now?
Well, the ECB can do one thing that the Fed can't. They can lower interest rates. So the ECB, in my view, has made a mistake in that they've raised interest rates twice so far this year. The second increase was clearly a mistake. So one thing that they can do is they can take back one or both and start to ease monetary policy.
And that could happen as early as what, Thursday? Isn't there an ECB meeting?
There is an ECB meeting later this week. So that's one possibility. On the other hand, again, they've just raised interest rates, and this is reminiscent of 2008 when they raised interest rates in the middle of the year between Bear Stearns and Lehman. So they've raised interest rates now, and the question is, are they going to admit in the sense that they made a mistake and take it back, or will they say no? Our mandate is inflation. We did it for a reason, and therefore we will stick with it.
Now it's ironic because economies around the world are slowing, and if you want to try to get them to grow, in theory, you want to make lending easier, right? That would be lower rates in Europe. Mm-hmm. It would also mean that you don't necessarily want to sue your biggest 17 banks here in this country for $196 billion, as the government announced that it would do on Friday. What do you think of that? Regulation and policy towards banks is a bit of a pendulum in this country. And during the crisis, there was a lot that was done to try and support the banks, throw capital at them, throw liquidity at them, throw different lifelines at them, regulatory forbearance, favorable tax treatments. There were a number of things that were done all to try and support the banks. Well, politically, that proved to be unpopular. And now that the banks have survived, as it were, and sort of.
Well, they are where they are, and there's a lot of resentment on Main Street and in Washington that the banks have tried to go back to sort of, if you will, the old way of doing things, which includes paying rather hefty bonuses. And so they're like, well, if you can afford to pay these hefty bonuses, then you can also afford to reimburse Fannie Mae and Freddie Mac on some of these mortgages that, as it were, you packaged under, perhaps not the best of circumstances.
But let me ask you this. There have also been a lot of calls that have said Fannie and Freddie were sophisticated investors. They knew what they were buying, and you can't just blame the banks. Is that true?
I think that's fair. I mean, Fannie Mae and Freddie Mac were very important cogs in the mortgage market. To say that these were somehow unsophisticated investors is just plain wrong. So there's probably blame on both sides, and so you're probably going to get some kind of a settlement at some point where the FHFA is not going to get as much as it's asking for in the lawsuit. There'll have to be some kind of a compromise because you just can't say that Fannie Mae and Freddie Mac, who are were rather sophisticated operators, were somehow duped by these banks.
All right, what do you do now? Do you buy banks? Do you not touch them? I mean, how do you possibly trade these things? It's unquantifiable.
It is unquantifiable. My issue with the banks is the revenue side. So the revenues, have been weak now for several quarters running. The credit story, as it were, mostly was dealt with. There are these tails from these mortgages that are still lingering with the banks. But let's put those aside. Even if you do that, the revenue story is a problem because net interest income is coming down. The flattening of the curve.
Which is how they make their money, right? They borrow at one price, they loan at another.
Exactly. Now, what the Fed has done is they flattened the curve by pushing long rates down. That doesn't help margins.
That squeezes their margins.
Squeezes their margins. Then you have fee incomes. Well, you've had things like the Durbin Amendment, which has
cutting credit card fees.
Cutting credit card fees. fees. And then you have things like the Volcker rule, which has limited some of these activities like trading, proprietary tradings that the banks can do.
Which is the third way that they make money, right? So net interest margins, fees, and trading.
Trading, and then you have, well, not only Dodd-Frank, but Basel III, which is coming down the pike. Now, we're already hearing that they may ease some of these liquidity requirements that are being teed up to impose on the banks. So you've got a very tough regulatory environment.
And rejoining us once again, Dino Kos, Managing Director at Hamiltonian Associates. He is the former head of central banks and sovereign wealth funds at Morgan Stanley, and most notably, he also spent more than 20 years right here in New York with the New York Fed. Dino, you were literally the man who was running the open market operations for the Fed in New York. You're the man we want to hear from. You're also now writing on the Fed. Tell me what you are writing, the report that you're putting together right now that'll go to clients later this week.
Well, we are, what we're thinking about is about the data over the last few weeks. The data has been really very, very bad. So if you think about Friday's employment data as being an example, the ISM data the day before, is we have an economy that's literally come to a halt. So.
Is it really that bad to a halt?
Well, in Q3, if you just look at the work week shrank. There was no employment growth. That feeds through into GDP. So, we're talking about an economy that's growing at less than 1%.
Right.
In the first half, it grew at about 0.75%. So that's 3 quarters in a row, essentially, where we're talking about sub 1% growth. That's no employment growth. So, really the pressure is on the Fed to, quote, do something more. Now, ideally, the government should be doing more, but the government is out of bullets and there's political gridlock.
When you say the government, you mean Congress and the president?
Congress and the president, right, exactly. There's only so much that they can do, both because of ability, but also because of political differences. And then that's going to put the ball right back in the Fed. And so, here we are. The market is anticipating more action. QE3.
Okay, Dino, we have, forgive me, we have 30 seconds. What does the Fed need to do? 30 seconds or less.
They're going to, what they will do, I think, is they will take further action. Probably there's 2 levers that they can pull. One is buy longer dated securities. Second of all, just buy more assets. That's for later on.
And by buying those longer securities, they're going to flatten the curve and make it harder on banks to make money.
It's one of the side effects. It's not what they're after, but it's a side effect of the policy that they're on.
All right, Dino Kos, formerly of the New York Fed and Morgan Stanley, now with Hamiltonian Associates. All right.